Hello, everyone, and thank you very much for joining us on this Wednesday, March 25th, for our China Update webinar. My name is Ian Saunders, with an analyst here at NASDAQ Dorsey Wright, and we are thrilled to be joined by Brendan Ahern, who is the Chief Investment Officer at KraneShares. KraneShares, for those of you who might not be aware, is an investment management firm that focuses around investments in China. Brendan is, as I mentioned, the Chief Investment Officer at KraneShares and is also the head of their research. So we thought there'd be no better person to come in and speak about the current landscape within China, what we see going on as they begin to come out of their own COVID-19 crisis, and how this might relate to what we might expect here in the US and in other areas around the world as we all deal with the continued effects of the COVID-19 virus here. So today, Brendan's going to provide some perspective around movement we see going on within China, how that looks more from an economic perspective, and we'll also loop in some technical perspective as well from our end, some interesting movement that we see going on with the individual equity prices there in China as well. So without further ado, I'll go ahead and pass things over to Brendan, and we'll jump right into things here.
So I'm going to start with really the human element. I think these are things that are important for your clients to know, which is first and foremost that coronavirus really hit in China, but specifically it was in Hubei province. And why is Hubei province? What was the ramifications of this outbreak occurring there? Well, first and foremost is it's not a rich province even from a China standard. Its capital, Wuhan, is known as the Motor City of China due to large amount of automotive and auto part manufacturing. And why that's critical for your clients to know is that we all know that China has a high level of pollution, but in an industrial city like Wuhan, the air quality is even going to be low from a China perspective. That very likely created a population with an impaired respiratory system. The pollution in China, and specifically in Hubei province, is far, far worse than any city in the United States. So that's one reason why when the coronavirus hit, why it had such a debilitating effect was due to the air quality. The other factor of what's important is that smoking in China is very, very high rate. 50% of men smoke versus women. And so when you take a person with an impaired respiratory system who's also a lifelong smoker and give them a respiratory ailment, you've got a big problem. The other significant factor around Hubei province is that, like broader China, healthcare only represents about $400 from a GDP expenditure per person versus $11,000 here in the U.S. We enjoy here in the United States a standard of care that is light years ahead of what's available in China, and particularly a poor province like Hubei. We've all saw the photos of them building that hospital in just a few days because simply the healthcare facilities in China were just simply overwhelmed by the outbreak in Hubei province. And I think those are three key things that your clients should be aware of, is that this occurred in a poor province with very bad air quality. You combine that with a very high smoking rate in China and limited healthcare facilities, you've got a big problem. We're all very fortunate that even with coronavirus taking place here in the United States, we do have some significant advantages. The most important thing I think we're seeing from China that's important for your end clients is that globally, but particularly in China, the elderly and particularly those with pre-existing health conditions were disproportionately affected. As we age, our immune system naturally weakens. So when people who are old, they get any sort of ailment, it's significantly more serious. But if your body is already fighting a pre-existing health condition, it makes it much, much more difficult. And I think that's something that is important, that people who are older, particularly those with pre-existing health conditions, particularly cardiovascular conditions, need to be especially careful because, like we're seeing in Italy, in Italy, the Wall Street Journal reported that 89% of the fatalities have occurred in those over the age of 70. 99% of the fatalities took place with those with a pre-existing health condition. And in fact, 50% were those with 3 or more health conditions. So those, again, it's important that your clients who are older and or with pre-existing health conditions need to be very careful. Now, China does show the effectiveness of the quarantine. They basically walled off Hubei province, but they did impose a national quarantine, an extended Chinese New Year's for several weeks in order to prevent people traveling around the country. They stopped domestic travel in a very significant fashion. They cut domestic air traffic by over 90%, but they also limited railroad traffic, road traffic. They imposed this self-quarantine, which really helped keep the virus from spreading. Now the virus itself it's akin to HIV is the virus, but what you get is the AIDS, is the disease, and coronavirus, COVID-19 is the disease. So again, the likelihood that someone who's older with a pre-existing health condition has a much higher propensity to see the coronavirus evolve into COVID-19. Now, what we're seeing here in the U.S. is obviously there's a huge debate on how extensive do we impart a quarantine, but it is important that on the corporate side we're being a very strong response. E and I are both working from home today. Obviously business travel has come to a complete stop. These are all smart moves to take. Our government officials were deciding the extent of this quarantine, but it's an important lesson from China was that the quarantine was very effective in stopping the spread. Now, shifting to an economic perspective, China's markets did come down in mid-January in a very dramatic fashion. But when the market came back, and arguably China is kind of benefiting from a first in, first out, the market came back not universally. There were winners and losers. Now we know, the losers are very easy to identify. Anything travel related, tourism related, anything that requires large gatherings of public people. So obviously airlines, Macau casinos, hotel chains, publicly traded restaurants, amusement parks, movie theaters. Those were clearly continued to be the weakest within the China market rebound. At the same time, you saw companies that were geared to kind of the new China, companies that were geared to benefiting from increased activity driven by the self-quarantine. And those were really internet and e-commerce companies saw their usages increase very dramatically. For instance, people still need food. Even though if you're stuck in your Chinese apartment, you still need food. You need groceries. A company called JD.com actually raised their Q1 forecast because of the increased usage during the quarantine. You also have companies that provide online education as schools were shut. Parents still wanted their kids learning, so online education companies saw a pickup. Online content providers, so people as they were stuck at home, they were downloading more movies and TV shows. So online content providers also benefited. These kids, after they got done with their schoolwork, they wanted to play video games. So online gaming companies saw an increase in usage. And so you had this almost a disparity between old and new China. If you think about, the companies that are very labor intensive in terms of factory workers, those people couldn't go to work. At the same time, white collar professionals were able, these technology companies, these e-commerce and internet companies, their workers were able to work from home. And I think the real key here is that it gives us a little bit of a playbook of what we're very likely going to see here, or already seeing here in the United States. We also saw a very important policy response from China, and that helped support and stabilize the markets. I think we're seeing that occurring here in the United States. Obviously, the Fed action on Monday is very, very important to repair the plumbing of financial markets, particularly the fixed income and the credit markets were totally frozen. We also had a very strong fiscal response in China in terms of policies to support the economy, and obviously with an agreement taking place in Washington, we're going to see that here as well. At the same time, the things that we do have to prepare for, that the most important thing that I'm tracking on a daily basis is international air travel. That international air travel showed us how this spread. And that's international as well as domestic. And while the United States and China took very strong moves to limiting, curtailing international travel, that other countries have been very late to that, and that will tell us where Corona is going to affect. So part of what's happened in Europe was they did not do the same travel curtailment like President Trump did in terms of air travel to and from China. And that's part of the reason why northern Italy is being unfortunately so adversely affected, was air travel, say from a Milan to luxury good providers in Italy traveling to and from their factories in China. Switzerland only closed their border with Italy about a week and a half ago. So unfortunately, some element of the spread is due to air travel. And so I use a lot of travel apps, and I just simply look at airports. I just pull up a map of air traffic. And we're seeing a much stronger response today. At the same time, there are signs that some countries aren't taking this seriously. And I think from an investor perspective, that's very, very worrisome. So what's the main lesson that we can learn from the China quarantine? Well, the China quarantine, again, was very, very significant. From start to finish, you had almost a 2-month time period. So this is going back to the start of, say, Chinese New Year through today. And today, China has no new cases. They've successfully stopped the spread. We're leveraging here data from our parent, China International Capital Corporation. CICC was co-founded by Morgan Stanley in the 1990s. Many of their senior managers are legacy Morgan Stanley. The chief economist had been Goldman Sachs, China chief economist previously. So I know there can be skepticism around China data, but we think this data, just due to the roots of Morgan Stanley within CICC as the largest investment bank in China, is very important. So what we can see here is where are different countries on the path, and obviously China, as kind of first in, first out, has successfully moderated this. We here in the U.S., we're just going into this corporate self-quarantine, followed by, municipal and state quarantines, which means that, the trajectory, we're still unfortunately in an early stage, that we need to prepare our investors that as testing increases, we're going to see more cases reported here in the United States. That's something that we saw in China, that as testing became more prevalent, the cases increased very dramatically. And that did move markets to the negative. At times, though, what was important was that the rate of growth, as it declined, the markets there did stabilize. that's a trend that we'll see here in the U.S. as well as elsewhere. Now, on the positive side, we are seeing countries like Japan and Korea are coming out of this, and I think that's important from an investment perspective. But China did beat this through the quarantine, and we can't do what they did in terms of forcing citizens to stay at home. But likely, I think corporations will lead the way, as well as supportive policies from the U.S. government, both on a national, state, as well as municipal perspective. And we as individuals, some element of this is in our hands, and that's part of the reason why I've been self-quarantining myself, me and my family. I've told my parents not to go out into public areas. They're older. That their immune systems, because they're older, puts them at a much higher risk level. Again, unfortunately, we are seeing cases increase globally, but there are some signs that hopefully this cycle, this too shall pass. Now, what we can also learn from China is the economic consequence of the quarantine. And now China is unique in that the Chinese New Year's is a huge week-long plus vacation. So you always have this V take place in China. Economic activity falls off as people really punch out and go on vacation. But due to the quarantine, as you saw, limited activity due to the quarantine. And now that China has really started to go back to work in a very significant fashion, what we're looking on the left-hand side is how much of China's economy is back online using CICC, high-frequency economic data that, really about, we're just over 80% of the country is back at work and basically back in the factories, headed back into the office. And that's having an effect. We're seeing, say, on the right-hand side, freight logistics utilization. How much are trucks on the road, railways, port activity? We're seeing a big rebound in terms of China's economy, and that again shows us to an extent what we should expect here in terms of economic consequences due to the self-imposed quarantine. Civil transportation is really looking at, subways, railways, buses, and again, white collar workers, it's much easier for them to work from home. But what we're seeing, say, the factory workers, proverbial blue collar workers who have to be at work to earn a paycheck, is pushing increased usage of transportation, public transportation in China. Property sales. So property sales is a good indicator of almost not just consumer confidence, but one's ability to get out and actually look at, say, apartments in the case of China. And we're seeing property sales rebound in a very dramatic fashion over the last several weeks as the national quarantine has been lifted in China. Even Hubei province on April 8th will see its quarantine in the city of Wuhan. People are going back to work. And so we're seeing a bit of this V-shaped rebound in the case of property sales. Now, I know that in general there can be some skepticism around Chinese data. Even despite the roots of CICC, potentially some people might doubt this. But importantly, last week, we can look at other say multinational companies doing business in China to really verify this data that we're seeing from CICC, and we're seeing this data verified from not just brokers or institutional brokers in China, but certainly even global institutional brokers we utilize are showing very similar data as such as CICC. But here's FedEx's on their earnings call. Basically, they're saying that air freight, FedEx's air freight into and out of China has returned to a pre-Chinese level. So this is a great indication that China has gone to work in a very significant fashion. And so part of what you're seeing is as people go back to work in these factories, they're demanding more inputs. They need more of the raw materials to create processed goods. And what you're seeing, the output are exports. And so FedEx is benefiting from this pickup in activity as indicated by their air freight into and out of China. Just last night, we had Nike's earnings. Nike, they closed 5,000 of their stores in China. Very dramatic due to the quarantine. But there's two important lessons from Nike's earnings. One was that the Chinese consumer, just as I had mentioned, that just as we saw a lot of these internet e-commerce companies, online gaming, entertainment, and education actually saw an increase in activity. Nike saw the same thing. They saw consumers pivot from going to stores to leveraging online. And for this reason, the revenue in China for the quarter, even despite the quarantine, it only fell 5%. Now I would say Nike has demonstrated that they've got a very strong management team, not only here in the United States and China, but their ability to pivot from kind of offline retail stores to online is very important. And I think, again, your end investors, you as you put your investment hat on, we can start to ascertain what are the types of companies that are going to benefit here in the United States. I think about Amazon versus Kohl's. That online, brick and mortar will suffer as we self-quarantine, whereas online geared companies are apt to benefit. Just this morning, Cargill came out and said that their poultry processing in China is back over 80% of capacity utilization versus during the thick of the quarantine, it was about half that. They were only running their chicken processing, their poultry processing at a 30 to 40%, but now it's back up over 80% from Cargill. Cargill is a private company. Now, in terms of part of the reason why has China's equity markets really outperformed other markets globally? So part of it is due to the fiscal response. It's interesting to note that China didn't cut interest rates. They didn't cut interest rates during the trade war. They didn't cut interest rates during the corona outbreak. But what the PBOC did was they pumped liquidity into the financial market. They kept their credit, they kept their fixed income market moving. They wanted companies to still gain access to credit. Now that's something that we just saw only this Monday from the Federal Reserve dusting off the GFC, the Global Financial Crisis Playbook, which was to keep the economy going, you have to keep accessing credit moving. And so I do think some element of Mondays was very, very important in terms of keeping the U.S. financial plumbing moving. Now what China did that very early, and that kept their markets from seizing up like we had over the course of the last 2 weeks. Not only here, obviously in the United States, but obviously it's really a global occurrence due to global investors, global corporations not being accessing credit. Now, fiscally, they did a very important, they wanted to support private companies, they call them small, medium enterprises, accessing credit. They made lending much easier for those type of companies adversely affected. But they also did a lot of measures to support the consumer, to support industries adversely affected, such as airlines and factories. And we're seeing, we're seeing those same measures taking place here in the United States. And so just as China, their markets have outperformed other equity markets globally due to a monetary and fiscal response. We're just in the very early innings of that response here in the United States, which makes me a little bit more constructive on the U.S. Now, obviously, China knows that the Q1 data is going to be very bad. That January and February economic data was poor, but I think there's signs of life that potentially the March data for China itself could be stronger. The other important thing is that the Chinese government thus far has not lowered its 2020 GDP target. So they recognize Q1 is going to be bad, but that means the market, the economy has to overshoot in Q2, Q3, Q4. So again, they know that Q1 is going to be bad, but they're pushing this fiscal and monetary response in order to try to basically get Q2, Q3 to outperform to the upside. I think what you could see here is we know the U.S. economy is going to be adversely affected, but it is important that if we can get this thing under control, that we could see this stimulus overshoot in subsequent time periods. Now again, in terms of what we can learn from an investor from China was, again, these asset-light companies outperformed. Again, internet, e-commerce, these companies saw increased usage. Companies, if you think about like, Facebook or, Amazon or Netflix, these are the types of companies that are going to see an increase in usage due to the U.S. quarantine. And we saw that, we know that is very likely going to occur based on what happened in China. The other important sector was healthcare. Was that healthcare did outperform in China. Healthcare has been really arguably the best performing sector in China. That obviously pharmaceutical companies need to create more drugs. Private hospitals saw an increase in patients, but we need to create more masks and the such. So healthcare is another area that coming out of the past 2 weeks where we saw this massive beta sell down in the U.S., what's going to lead us out of this? Again, I think it'll be these asset-light companies. At the same time, healthcare. Now, I know everyone on this call is going to allow those X's and O's to dictate where you are investing today. But I would argue if you look at the X's and O's on what happened in China, if you look at our model, the KraneShares model on Dorsey Wright, it would show you that those types of these types of companies in China were the beneficiaries. Now, looking ahead, one thing that I think is important is figuring out a little bit about China again from FIFO has come out of this past tense from terms of cases. South Korea is another one that I'm watching here because South Korea is much closer to being done with this. Japan is another one. Now, again, I would defer to looking at your X's and O's to drive those investment decisions. But for me, I think one element I'm seeing is we as investors at KraneShares, part of my optimism is that we've seen some of our funds, if it's like that's in the model, like in the Dorsey Wright model, like KBA is holding in there. KWeb came out of the model. Obviously Ian will touch on this. The other thing that I'm looking at is within broader EM. You might want to look at single country, but the other one that's interesting for us is KEMQ is our is our EM internet and e-commerce. And what makes me more constructive on KEMQ, for those of you who might not, you might not want to buy a China specific, KEMQ, the second biggest country weighting is South Korea. So you've got China holding up very, very well. But I think there's potentially you could see South Korea rebound as other investors recognize that South Korea is coming out of this. Now at the same time, what worries me is that some countries from a government level are not taking coronavirus very seriously. Some of us have become aware of, Brazil visited the White House. You saw the photos of the Brazilian president and his entourage, President Trump, and the Brazilian president has been completely dismissive of coronavirus, not just on a personal level, but in terms of government policy. That makes me very, very worried about what could happen in Brazil. In Mexico, the U.S. really forced the Mexican border to be shut. The part of that was President AMLO has been totally dismissive of coronavirus. I mean, he's had to change his tune a little bit recently, but that makes me very worried about what could happen in Mexico with coronavirus. The other one is Russia. Obviously, Russia is going to be suffering from low oil prices. At the same time, President Putin, if you go find some of his, he's totally dismissive of coronavirus. They've completely put their head in the sand, and so what we've seen is India is imparting a quarantine. Peru and Chile are imparting quarantines. In Santiago, Chile, I'm told there's actually the military is actually enforcing the quarantine. And so I think, again, if you're going to allow X's and O's to dictate where you invest, but I do think, what gets me worried, part of the reason why China really suffered under coronavirus was EM countries have such a low level of healthcare, and it makes me very worried about what could happen in other EM countries versus first world countries where we have much better facilities to handle this. Different countries are picking very different responses, and so in some cases they're just entering this, unfortunately. And so one is just looking at government policies. Another is looking at air travel applications to be able to see how much air traffic is taking place. It almost tells you how serious governments are taking this. And so some countries are coming out of this. I think that makes me more constructive on China and say South Korea, Japan. But I think, again, the most important thing to me, the most important value we can add to you today is one, providing some level of confidence that you can communicate to your clients that one, we're all very thankful that we don't live in Hubei province due to the higher level of air pollution. I'm not opining on anyone's health habits, but very clearly smoking and vaping potentially has a negative repercussion. But most importantly, the elderly and those with pre-existing health conditions need to take very, very special care of themselves. Limit their interaction with others. I haven't seen my parents in several weeks. It's for their benefit that myself and my family don't visit with them as much as we'd like to. But it's important that on an individual basis, there's things we can take. And more importantly is that the lessons that we saw from China in terms of the quarantine, even if it's from a corporate or a self-quarantine here in the United States, is effective. Disproportionately, the specific demographic is at a higher level of risk. And then we as investors, from an economic perspective, is I would argue that we're seeing the U.S. incorporate the same very strong economic kind of fiscal and monetary response that helps stabilize, help make China arguably the best performing equity market globally. That is taking place here today. I'm not planting the flag and saying U.S. equities have bottomed. I mean, we know that the headlines are going to get worse, but it's important that the fiscal and monetary response taken by the Federal Reserve, by the Trump administration, and by Congress are going to help repair the credit markets, the ability of corporations to borrow, and in China that was a sign of stabilization in the markets, despite the cases in China did increase, but that helped stabilize the equity market. Specific to investors, I think one, we have to recognize that China has gone through kind of FIFO. South Korea, Japan are shortly behind it. And that's where we as investors might be thinking. And then, certainly we saw a disparity between old and new China, that the companies that were more asset light, more geared to online, did outperform. Again, KWeb is down about 9% year to date. KBA is down 11%. And again, KWeb relative to other China ETFs, they're more geared to old China, heavyweights of financials, energy, industrials, materials. Those companies are going to be more adversely affected than these new China companies like we held in KWeb. And most important is that I think that is the lesson here in the United States. Again, I think you're going to allow X's and O's to verify that. Now, in terms of KraneShares, there are ways to keep abreast of these developments on a daily basis. On ChinaLastNight.com, we provide a daily update on what's happening in China. We have produced a financial advisor two-sider that reiterates some of these themes in terms of what we saw in China. Again, it summarizes the bullet points that I covered today. And if you just email me or info@KraneShares.com, we can get you those bullet points so that you could share some of this information we hope you find valuable. But again, most importantly, I just got to show a little compliance here. Most importantly, we want to help you provide quality information to your end investors during this crisis. This too shall pass, but China does show us a roadmap, both from how to limit this, but also what to do economically and where we as investors should be thinking about investing. So at this point, I'm going to basically hand things off back to Ian for a little bit of a review of what the X's and O's are showing us.
Perfect. Well, thank you very much here, Brendan, for that insight. And we will now take a look over to a couple of aspects that we have on the Dorsey Wright research platform that provide a little bit of perspective around where we see price movement going on in international equities and in China here specifically. So this page that we're looking at here currently is our dynamic asset level investing tool, our DALI tool, as it's often referred to there by the acronym. And what this page is doing, it's coming and it's taking initially these 6 broad asset classes that we have and ranking them according to relative strength. According to a relative strength tally ranking by these buy signals. And what you can do is actually come over here and go over to the history tab to see how that relative strength relationship has changed over the past few days or weeks or months or however far back you're looking to go. So you can come in here and see, click over here to ranking. And what we saw at the midpoint in February was we saw domestic equity solidly in the #1 position there on this tool. And international equities was just behind it in the #2 position, a position it had maintained for some time.
And the COVID-19 virus has gone around, as Brenda mentioned, once it began to spread globally outside of China to other areas in the world, we saw this lead to fair amount of sharp drawdowns within broader international equity markets. And that led to a very sharp drawdown in international equities in our DALI broad asset class rank, as you can see here. Over the course of a little over a week, it moved from a rank of second all the way down to its current position at a rank of ninth overall. And again, this is looking not in any one specific international equity area, but more the broad international equity space as a whole. So you can see there we had the 224 relative strength buy signals right there in mid-February, which began to decline slowly, ultimately leading to this large drop that we saw on March 9th. This drop of 63 buy signals for that particular asset class was the single largest drop on any asset class we've seen in at least the history that we have available here for the DALI tool. So what that represents is broad kind of weakness from the international equity space as a whole. Now, with that said, as Brendan mentioned, China, first in, first out, kind of began to lead itself a little bit away from the rest of the international equity space over the last few weeks that we've seen here. And one way to take a look at that separation, or rather the breakdown of the specific regions within international equities, is through our asset class group scores page. And if we jump on over to that page here, right now we're looking at the non-US view of that page, which is meant to represent all of your areas outside of the US market, all of your non-US, your international specific areas there, both from an equity perspective and from an income perspective. But in looking at this here, we have the different regional breakdowns for various countries or regions. And essentially what we're doing on this page as a quick background is taking a basket of funds corresponding to a specific region or a specific area, such as your China equity here, taking all of their fund scores from 0 to 6, 0 being the worst and 6 being the best, averaging them together, and that gives us an average score for the group as a whole. And then we rank all of those groups according to that average group score. And we see that China has separated itself from the rest of the international space by its high ranking in this asset class group scores page at a rank of 47th overall out of 135 different groups that we track. And then specifically within the non-US space, it is the top rank international equity specific group that we have here in this ranking, and one of the only ones, actually the only equity specific group on the international side to be scoring in favorable score territory, as we would identify as having an average group score north of 3.0. You can see most of the other international areas are much lower in the rankings, with many of them falling beneath our U.S. money market group that we use as our cash proxy. Areas like Brendan mentioned that are lagging a bit behind from putting some parameters around the coronavirus in their particular countries, your Latin America, your Russia. We've seen a little bit of upwards movement recently from areas such as Japan, like Brendan mentioned, that it might be bringing itself a little bit ahead of the pack. But China has maintained upper positioning and is actually ranked ahead of our core U.S. market on this particular ranking as well, as represented there by the S&P 500 Index Funds Group. They're pretty close together, but China has maintained that higher positioning over the past couple of weeks here when we've seen the broad sell-off in most of the international or most of the domestic space. China has maintained some strength that we've seen there, and is one of the few equity groups as well to maintain a positive score direction. So while its China score has fallen, it has not fallen nearly as much as most of the other international or even the other domestic groups, equity-specific groups that we have here on the platform. And in order to dive deeper into that movement within the individual China group, clicking on this link will actually bring you to this page here, our technical indicator report for the Chinese funds. And what makes this page interesting is you're able to come in here and see how many different funds are participating in movement, right? So we have our bullish percent indicator for China equity funds. And what this is going to show us is what percentage of China equity funds are on a current point and figure buy signal on their intermediate term chart scale. So as you can see here, this chart is not something that moves around all that quickly, and it tends to have pretty extreme movements. But you'll notice here we have a reversal down up here in February of this year that ultimately led this particular indicator from 96%. So in January, we had 96% of Chinese equity funds were on a point and figure buy signal, had a column of X's that had exceeded their previous column of X's. And this indicator fell off quite sharply amid the pullback that we saw there within Chinese equities in February, and ultimately led the indicator all the way down to a 2% reading. So out of the Chinese equity funds that we track here on the system, or that are classified there in the China equity group, this indicator fell all the way down to 2%. So only 2% of the funds were on a point and figure buy signal, and this is pretty much akin to what we saw back in the difficult time frame for Chinese equities back in 2015. A very similar decline. We were above 90%, moved south relatively quickly, not quite as quickly as we did recently here, but ultimately fell down to that 2% level. And then back in September of 2015, the indicator reversed higher and carried it all the way back above that 90% threshold. And we saw after movement there yesterday, broader US markets had some gains, and this led to some advances as well there in the Chinese equity space yesterday. And this indicator, the bullish percent for China, ultimately reversed back up into a column of X's yesterday, as you can see there by those green X's. So that's a good sign that we're seeing that increased participation. And again, these indicators are not something that move around all that much. It takes a fair amount of movement to get the funds to change signals. And so the fact that we're seeing this increased participation from Chinese equity funds is certainly a positive sign to be taken as we look towards the next few weeks here. Another indicator that I think is presents a pretty powerful picture from this page on China's kind of broader relative strength, as we saw there on the asset class group scores page, is this RS positive. And so what this particular indicator is looking at, it's taking that same basket of Chinese equity funds and saying, okay, out of these funds, what percentage of those funds are on a relative strength buy signal against the broader market? So this is looking at each individual fund's specific relative strength comparison against the broader market, and how many of those are going to be on a current buy signal on that relative strength chart. How many have demonstrated longer term relative strength relative to the broader market? And in looking at this, we see the indicator had fallen off there a little bit last year, fallen off a little more to form that double bottom in February, reversed higher here at the end of February, early March, and has climbed significantly over the past several weeks to now have 80% of China equity funds that we track here on the system showing positive relative strength against the broader market. That's a pretty powerful sign and a pretty powerful picture, I think, that speaks to the separation that Chinese equities have shown relative to the broader global equity space, international and domestic included there. So again, with 80% of funds, we've seen that this indicator moves around even a little bit less than our bullish percent does, and it has a tendency to remain at elevated levels for a prolonged period of time. So with obviously the potential there, indicator could continue higher. We saw a reading as of yesterday of 80.82, so it doesn't move all that quickly, but definitely another positive sign to be taken on the longer term picture for Chinese equities, as we see that they have continued to demonstrate positive relative strength amid the kind of global uncertainty over the past couple weeks here. And we've seen some of that relative strength reflected as well in some individual RS comparisons. So as an example of those, if we jump on over here, this is looking at a relative strength comparison of the KraneShares China A ETF, their ticker KBA, against the broader emerging markets representative EEM. We highlighted this in the webinar we had a few weeks ago there, that this particular chart moved to a relative strength buy signal against the broader emerging market space that we saw there on February 24th of this year, was that buy signal that we were given there at an RS reading of 77.4548. And so what that's showing us is we reversed up into a column of X's here and in mid-February, and that buy signal again represents that longer term positive relative strength against the broader emerging market space. And over the last few weeks, that has done nothing but advance. Right? It's moved significantly higher here in this relative strength comparison. As you can see from the prior chart, this is another chart that doesn't move around all that much. So to get this further outperformance of Chinese equities, this picture really speaks to that outperformance of China relative to the emerging market space specifically. We can also do some other comparisons. So if we wanted to compare the China A share space there with the ACWX, kind of broader international equity specifically, very similar picture that we see here. It moved to that buy signal on this time the 27th of February, and has further shown outperformance against the rest of the international space that we have there. So this is looking at international equities, obviously not including the US, consistent outperformance of both emerging markets and developed markets around the world. China has consistently continued to outperform those over the past couple of weeks. And then if we even bring this over to a global equity position, looking at, let's include the US into that global markets, pretty much the same picture that we see. So that really speaks to how the outperformance that we've seen in China has continued to be demonstrated there, looking at just emerging markets, international markets, and then throwing in the U.S. as well with the global comparison that China has continued to outperform its peers really around the world over the past few weeks here. So definitely a positive sign that can be taken from these charts, as well as the prior relative strength comparisons and absolute strength comparisons that we had there. And the difficulty that we did see within Chinese equities there throughout the kind of mid-January into February that we saw did lead to some strength changes that we saw from an RS perspective within China itself. Brendan had touched on those a little bit. We did see some rotation within the model that we have here with KraneShares or KraneShares Dynamic China Rotation Model. The way that model is run, it's going to seek to hold as many of the equity positions within the universe as possible. We did see that 3 of those relative strength comparisons did move to a negative relative strength against our China commercial paper representative from KraneShares there, the KraneShares China Commercial Paper ETF KCNY. And so the way the model's designed, when enough of those RS relationships move to sell signals, right? So when not enough equity related positions are showing positive relative strength against the China fixed income representative, the model will actually begin to allocate a portion towards that China fixed income representative to maintain full investment to China. But here we're looking at about a 75% current exposure to Chinese equities through KBA, KALL, and then KMED. And then the remaining about 25% is going to be taken up by the KraneShares China Commercial Paper ETF there, KCNY. And so as this is the first time we've seen that more kind of defensive positioning come into the model with that KCNY ticker, I did want to throw things back over to Brendan to maybe give us a little bit more perspective around the China Commercial Paper ETF and how that might be a little bit different or might be similar to some of the commercial paper or fixed income related funds that we'll have here in the U.S.
Yeah, thanks, Ian. KCNY is comprised of commercial paper. So commercial paper is basically what money market funds hold. The commercial paper market in China is a very, very large market. The market cap is probably about $500 billion. And so it's a very deep and liquid market. So KCNY holds investment grade corporate paper in China's bond market. So it yields around 2.5% today. We distribute on a monthly basis. You do have exposure to the renminbi, Chinese currency, and so I think some of the it's interesting that obviously EM currencies have just been destroyed just due to this mass exodus out of risk assets globally that's driven the dollar very, very high. But because China has not cut its interest rates, the renminbi is held in very strongly versus the dollar on both an absolute and a relative basis. So it's basically it's a money market fund in that it holds commercial paper, but you do have exposure to the Chinese currency, the RMB.
Wonderful. And so as mentioned there, this model is something that is evaluated each and every week, and it's looking at those individual relative strength comparisons of the equity related positions, each of those in this particular lineup outside of the KCNY. So comparing each of the other 7 against KCNY and that China commercial paper ETF, to looking for that longer term RS buy signal. So we did see a few of those funds that had moved out here recently. These 4 remaining positions will be the current model holding. So again, the 3 equity positions in KCNY taking up that 25% spot. And so this is something that is evaluated each and every week there. We do with trades that would be coming out on Tuesday mornings. And if this is something that you're looking to follow here to be alerted to future trades, whether you're looking to invest here, as well, it can also be helpful in presenting a picture of what kind of strength we're seeing within Chinese equities itself. We have the China group, as we went over on the group score, some of those indicators that are showing that broader participation, that broader improvement from China relative to the rest of the world. But this is a great way to come in and actually get at those areas within Chinese equities that are outperforming the actual China market there in and of itself through a fixed income comparison. So you can set an alert for this model coming in on the platform by clicking on this little bell icon here in order to get email alerts on any of these potential model changes. So with that, I again want to thank Brendan very much for joining us here on this Wednesday morning. And thank you all very much for coming in and taking a little bit of time out of, I know what must be a busy day going on out there, especially those of you that are joining us from your working from home as well. This I do as a quick aside. This webinar is going to be available in a replay format as well as a podcast. For those of you that are looking to get this information in the future, we'll have that replay information available here shortly. So thank you very much for joining us here, Brendan.
Thank you, Ian, and thank you very much for the opportunity. And certainly, just safe. Certainly hope everyone out there is safe. And certainly, if there's any way that we can be a resource, we're always available. But certainly, stay safe, both on a personal as well as financial basis. And I know following X's and O's on the latter, it's going to go a long way to help.
Wonderful. All right. Well, thank you very much, everyone, for joining us here as well. And we look forward to talking with you here soon.